So we are going to get started. We've got a lot of best laid plans going on right now. As you probably already know, the caterer is late, and so we're going to go ahead and get started because we want to end on time. But we'll pause so everybody can get some breakfast in the back. But we want to keep things kind of moving along. You guys all know this. I mean, life never goes according to plan. That's one of the reasons we're here, because when we have an uncertain environment, it's really good to kind of have some plan as to how to get from where we are right now to where we're going in the future. And so that's why we love the cycle chart right here, 2024-25, a changing landscape is what our guest speaker, Brian Beaulieu, will be talking about this morning. So we don't have also, normally we give a few minutes of the Communities Foundation of Texas people coming up to present on that, so I'm gonna fill in for that role. This is a great facility. We've been hosting this here for, it's at least 10 years now, and almost 10 years. And it's been great. And so they love to partner with different organizations, so I would suggest if you ever have an event or wanna partner with them in any way, reach out to the Communities Foundation of Texas. So I've got their plug-in, so we're good. So who are we? I never used to talk much about Baird, but somebody was reminding me of this morning. When I started at Baird, we had about 300 employees. So flash forward to today, and I've always talked about, well, we're one of the fastest growing financial services firms in the country, 5,400 employees. A lot of accolades we get. I'm proud of those things, but what we're most proud of is 20 plus years now on Fortune's Best Places to Work list. What that means is we can attract a lot of great people to come work with us. And so that's how we built. Some of those people are here today. Mark, why don't you stand up? Mark Stevanik is the manager of the Dallas office. Norris Anderson-Sellerud is here. Brian Campo and Claire Delancey in the back from Baird. So if you have any questions about Baird, please feel free to reach out to any of those folks, and they can answer that for you. So our presenter, I've known Brian Beaulieu for almost 20 years now, Brian, if you can believe that. So Brian's gotten more gray hair than I do, but less weight, so that's good. So we wrote a really interesting paper, asset allocation, the business owner. So if anybody wants a copy of that, we can certainly provide that to you. But the thing that really, and it talked about plans and, people have a tendency to overreact and underreact to different circumstances. Take me, for example. So people are asking, what happened to your head here? Well, I'm out at we move out to a lake place in the summertime, and I'm out trying to put a trailer hitch on a new vehicle that we have that I've never used that for before. And I'm trying to get the cover off, and I couldn't get the cover off. And so I go online, I look up how to do this. It says tug really hard. All right, okay, I'll tug really hard. So I walk over, I'm like kneeling like this, and I'm tugging really hard. I guess, well, maybe not tug hard enough. Tug hard. I tug so hard, the thing comes flying off my head, smashes right into the bumper, and I fall over, and I'm looking and seeing stars. Okay, and it's like, we all have a tendency to either overreact or underreact. And so the reason that we pay attention to what's going on in the cycles is to know where we are, so we're reacting appropriately. We don't want to ever overreact based off of anything Brian or I say, or we hear on the news or radio. We don't want to underreact either, okay? So with that, I'm going to turn it over to our speaker, Brian Beaulieu, who will, when he sees the food out and back, pause for a second and let you fill your place, and we'll go from there. Do you need this, Brian?
Thank you.
Thanks, all right, Chris. Thank you. Let me welcome Brian.
Thank you. The truth is, I stopped dyeing my hair. He hasn't. So don't look hurt.
What?
Don't look hurt.
No, I'm not hurt. So quick story about that. So one of my son Mike is here today, but one of my other sons at a family gathering, my brothers all have gray hair. And so they're all like, Chris, well, why isn't your hair gray like ours? My son, without missing a beat, says he dyes it. And now they never believe me.
All right, we're here to talk about the economy. We're going to find a break in about 10, 15 minutes so you folks can eat. And then we'll come back to talking about the economy. Then Chris is going to take it up after that and talk about what it means from his perspective and therefore how it can help you folks. Let's see if I can get... There we go. I always start every presentation, we have been doing this for about 10 years now, with our report card. This is how we did for 2023. For GDP, we came in with a 97.8% accuracy rating with a forecast that we laid down 15 months before the end of 2023. 99.8, 99.7, 95.7 for Canada, if I'm reading across correctly. And then you can read the others until you get to housing. Housing continues to be a problem in terms of our forecasting. What I got wrong with that 89% accuracy rating was I did not anticipate the lack of inventory that was going to persist out there. I know the numbers. I just thought there'd be enough people aging out of their big homes that there would be more movement in the market, and it just did not come to pass, and therefore we have an accuracy rating that didn't work out particularly well. So I'll tell you what I do right, and I'll tell you what I do wrong, and he makes me in particular embellish what I did wrong, so that's it, I'm done. The economy, and I was talking to Bob about this before, the economy is downright weird right now. And that's what happens, I think, when you find yourself in an overstimulated environment. What you're looking at here is, with the light blue line, is GDP for services. And you can see that continues to move up without hesitation. And then the darker blue line is US industrial production, which is manufacturing, mining, and utilities. And that's going nowhere as fast. And the delta between the two continues to grow. So what's the first takeaway here? Service sector is obviously going to be a better place to be during most business cycles, so take that home to your kids or your grandkids. Second thing is, come the 2030s, that light blue line is going to hold up a whole lot better than that dark blue line, because that dark blue line is going to carry very little momentum into that 2030s period. And if you haven't heard ITR talk before and you don't know what I mean about the 2030s period, we're anticipating that for factors that I will gladly go over, it's going to be a difficult decade. It starts in 2030 and the downturn doesn't end until 2036. But then the glorious part begins, because on that next rising trend, we're good for gold. So we have to go through this reset. So when I refer to 2030s, I'm talking about a prolonged, very difficult period for the economy. And then I'm going to break that industrial production up into two other sectors: high-tech industrial production, which is blue, and excluding high-tech industrial production, which is green. Which trend line would you rather be on? I mean, it's pretty clear to me where the future lies, and it doesn't lie on that green line, at least not if you want to have a nice, strong tailwind. That doesn't mean there isn't a lot of money to be made on that green line. There is, but it takes capturing market share, being exceptionally good at what you do, and making it better without much of a tailwind behind you. I mean, that's the economy we live in today. And I want to see that circle? That's all this stimulus that's being applied via the CHIPS Act, the infrastructure bill, all of that's tied into that really strong acceleration. And that's distorting markets right now. When you look at construction wages, they're not normally this high, this deep into the business cycle. You look in construction machinery, equipment, production, new orders, that's not normally this high at this point in the business cycle. Clearly, that fantastic level of stimulus has had an impact on that line, and that line is really by itself only about 5.8% of overall activity, but it is having a monster ramification effect, consequences that probably were not well thought out. One of the premises of what we're going to be talking about is this government of ours is rapidly going deeper and deeper into debt to fund that line and all the other social programs going along with it. And that debt is part and parcel with the 2030s. It is not a sustainable trend. We're reaping the benefits of it now, but we pay the price for it down the road. That's the way it works in economics. You often have a trade-off in time between what's good and what's not so good. And I'm not supposed to say good or bad, what's up or down, or it's not neither good nor bad is the way it works out. Is it going to matter who the next president is? We'll talk about that in a moment. I just want to lay that thought down first. This is a 12/12 rate of change comparison between U.S. industrial production and material handling machinery new orders. Now, if you're not familiar with 12/12 or rate of change in general, what we're doing is we're taking 12 months worth of data ending March 2024, and we're comparing that number to the same number ending March 2023. And U.S. industrial production is essentially flat with where we were this time last year. For the last 3 months, we're actually down a little bit, but when you look out over a year, we're essentially flat. Material handling is in nominal dollars, and you can see it follows along that industrial cycle pretty clearly. I just recently did a material handling conference, is what it was. And it was amazing. The haves and the have-nots, even within that, 5.5% up. I got to tell you that I must have talked to a bunch of distributors that were telling me, well, I'm down double digits. I'm not up 5.5%. There's so much excess capacity out there right now, and some of you may be feeling that also. And this is a case of that excess capacity. We had supply chain issues that were intense during the COVID recession. We said, get me all you can, so they got us all we wanted, and now we're stuck with some inventory as the trends normalize. And some of you may be feeling that also. In other words, it's not one easy economy to talk about anymore. It is a lot different than it normally is. When will it normalize? I don't know. When the government stops being irrational, perhaps. When we wind our inventories down, perhaps, and we don't overload the supply chain. Those are things that have to happen before we get into true normal territory. This is our forecast of U.S. industrial production. We have the rates of change on the upper portion. That's scaled on the left here underneath ROC. And you see we have that rate of change, the 12-toe, just barely slipping below zero. Last time when I was here, Chris, you may recall, Brian, you may recall, I had it going down a little bit lower, about -3%. Now we have it ending the year essentially flat, down just a few tenths of a percentage point. Why the improvement? Because of what's going on in that high-tech industrial side of things. It is keeping the industrial base up more than we had anticipated. And then see, we get through 2024, and those bubbles start rising above the zero line. That's because 2025, we're into a brand new business cycle rising trend. So that's the worst that we are going to have to experience in the worst part of our economy, the weakest part of our economy. And then we're into business cycle rise again in 2025. And after 24 softness, we see 25, 26, 27, 28, and 29 as being up years. Varying degrees, varying slopes to that rising trend, but 5 years. My biggest concern for you is in 2024. My biggest concern for everybody in this room is, do you have enough working capital to make that rising trend work? Because growth consumes a lot of cash. Do you have access to that cash in this banking environment? 2, where are you going to find the labor, folks? You're using a lot of your cash to invest in technology so you don't need labor, but you're still going to need bodies. Where are you going to find the bodies? And 3, although a lot of you look young, do you have enough energy left in you for that next 5-year push on the upside? I clearly didn't because I'm selling the business, but that's me. Do you have those 3 things in sufficient supply to make a good run at it? If you're my age, the way around the energy is you make sure you have a deep second bench. Do you have that deep second bench? And that also sets you up for, if you want to sell the business, you're going to need that deep second bench of managers underneath you anyways. This is a win-win situation. If you haven't invested in those people, you seriously need to be investing in those people. Then you can see the data trend reaching a December 2024 low and starting to rise on the other side of that. We already have leading indicators telling us about 2025. It's not like I have to do a whole lot of guessing in terms of this timing. The leading indicator trends are there, from the ITR leading indicator to the ITR retail sales leading indicator to purchasing managers index. They're all telling us the same thing. That rising trend is going to be there. This is a comparison of North America, because I think North America is going to be the economic region to beat for the next 20 years. So I want to show you amongst the North Americans, the US, we've got this nice growth trend going. It's not strong enough. And you'll notice the blue line where we are, we haven't come back to our pre-COVID highs yet. We're not there yet. We have more recovery to go before we get back into growth territory. Look at Mexico's slope, that tangent line. They're above where they were pre-COVID, and that tangent line is steeper than ours. Mexico is growing faster. Mexico's likely to continue to grow faster, not because they're the better economy, but because of onshoring or near sourcing. It's a lot of the Chinese activity is going into Mexico. A lot of the other foreign direct investment is going into Mexico. In fact, Mexico and Canada are tied for number 3 on the planet for destination of foreign direct investment. The US is tied for number 1. I'm not tied, we are number 1. And then there's Canada, which also has slope better than ours, but they're not currently rising. In fact, they're running below that long-term trend. They peaked over the COVID level, pre-COVID level, but they're lagging behind right now. Canada remains one of our go-to economies for the 2030s. I'll say it multiple times, but just to get it into, we are still enamored with Australia, Canada, Switzerland, and Sweden as safe havens during the 2030s. That has not changed. In fact, it's only grown stronger in our minds, that that's where you want to be focused in terms of some of your finances. Stepping on some of Chris' toes here just for a moment. From my analysis, folks, and I look at a lot of trends I have in real life, my analysis shows you've got very, very little reason to invest outside of North America and specifically outside of the United States. I didn't bring along all those charts. I'm just telling you that if you can be North American or US centric, you're going to do better than if you take the risks of investing outside of this country. This country is so strong, despite our concerns politically. It is so economically strong, even with the 2030s in mind, that there's no other place that you want to be investing. Well, here's how the US economy performs under different administrations, from Eisenhower through Kennedy. You can get red versus blue through Biden. Start with Bill Clinton. See that 3.8%? It dropped down to 1.9% under George II, right? And then we go to the Obama administration, radically different administration, different view of the world, 2.0%. Then we go to Donald Trump. Again, radically different view of the world, hit by COVID, 1.8%. And then you have Biden at 3.3%. If you see my brother Alan speak, you know that he doesn't allow our speakers to use this chart because he says it gives it's subject to misinterpretation. It looks like Joe Biden single-handedly increased the rate of growth in the US economy. What you're looking at is what happens when you dump an unprecedented amount of stimulus, fiscal stimulus and monetary stimulus onto the economy. It lags behind when you start pouring on the gasoline. It's no instant combustion. And now Joe Biden's benefiting from that. But I'm telling you, the next administration, whether it's Biden's or Trump's, is going to benefit from all the deficit spending that Biden's involved with today, along with the Congress. The economy is going to run hotter than normal through the next 5 years, is our view. And that you need to keep in mind because that is tied into why we think there's going to be a whole nother round of inflation that we are going to have to deal with. It is latent, it is out there. The signs of that next round of inflation are very clear from our perspective. And it doesn't matter whether it's Biden or Trump in that seat. It's going to be what it's going to be. That die has already been cast. So vote, whoever you want to vote, it's not going to matter. Vote for me and I'll set you free. Obviously, there's social reasons why we vote. I'm just saying economically, it's not going to change the trajectory of the country. If you want to know more about what's going on near term and longer term, come back after breakfast because it's time for our breakfast. Please help yourselves and we'll come back. Okay, now you're a breakfast entertainer. I hope everybody got the food they wanted. Feels good? Shall we go? Okay. We're going to leave the politics behind, and we're going to start talking about inflation and interest rates. We've had a new bank failure, so noteworthy. And the US dollar, I'll touch upon real quickly in case anybody's interested in that. Here is the consumer price index rate of change, 312 rate of change, and that's the light blue. And then the dark blue is the producer price index. And the producer price index is running at 0.7% rate of inflation. It has slipped into deflation. Now it's running at a modicum of inflation. The CPI, we've changed that outlook a little bit. We've extended the decline because of the stickiness that we're seeing right now. It reaches a low, in our view, around mid-2025 at about 2.5%. And given that the core price index, personal consumption expenditures core price index excludes food and energy, runs about half a percentage point below the CPI. So the Fed's gonna, we think, see their way through to that core inflation rate that they are striving for. Their 2% is what their goal is on their personal consumption expenditures price index, core. And we think they're gonna be able to see it. It's delaying the onset of decline in interest rates, but we don't think it's taking those interest rates off the table in terms of some decline. It's not gonna be a big decline in interest rates. It's not gonna be enough to move the world or move your world, but it is gonna provide an opportunity for some lower mortgage rates and some lower long-term interest rates if people wanna take advantage of that. If you can see that rise in the blue and the gray bubbles, we think that's the beginning of a whole new wave of inflation that's going to be coming at us. It's going to be driven by the stimulus that is being put upon the economy right now, in particular by the way we're funding that spending. And it's going to be driven by this perpetual cycle of a labor shortage and what that does for the price, wage, labor cycle. Those are the two principal arguments for that inflation. Now, that's going to be a defining characteristic of our economy until around 2030, 31. The inflation will lag behind when growth peaks and starts to come down, all right? So it's not like it's an instant shutoff valve. The economy starts to weaken 1 to 2 years before the CPI and the PPI will actually go downward in a period of disinflation. That disinflation is going to turn into deflation. That's when prices are actively declining, from commodity prices to home prices to just about everything. Prices should be in active decline. Think about what that means. It is profound. If you think something is going to cost you more next year, you tend to want to buy it this year because it's only going to cost you more next year. So if you have the cash, I want it now. But if you're in a period of deflation, it's the opposite psychology. Why would I buy that brand new TV just because it's got new technology when I know next year it'll cost me less money than it would this year? I'll hold off unless I have a bad TV. Same thing with a boat, same thing with a car. It delays consumption when you're in a period of deflation. Inflation is like a cancer that rots the economic body slowly from within. Deflation is like all of a sudden your limbs have turned gangrenous and something radical has to be done. I know, I shouldn't have said that word, huh? That's kind of gruesome. It's just what popped into my head. Sorry. I will filter that for the next group so that we don't go down that ugly road. My point here, though, is this is a relative calm before you have to lean real hard into the reality of inflation. And then you're going to have to really change tact. If you're a skier, I'm talking about, you're going to hit those other edges really hard to come back the other way because of a period of deflation. Two radically different environments in which to make money. But that's the whole point of this thing, is so that you make money. I'm not much of a social philosopher. I'm just here to help you make money. This is U.S. Material Handling Equipment Producer Price Index, and you can see the deflation that's going on there. If you've been here in prior years, this snake head here, that neck rising up, you've seen that before, because that's exactly what retail sales went through. It's exactly what Peloton went through. It's exactly what household furniture and patio furniture went through. And many of your businesses went through it too. And now they're leveling off and they have to normalize. The big question is, will that price trend normalize all the way back down to if I were to draw another tangent line, or is it going to stay elevated? The early evidence is it's going to stay elevated. We're not giving back the price increases that we've managed to get hold of. And that's another differentiator about this business cycle. It's why corporate profits are holding up really well right now, despite where we are in the cycle, because they're not giving back the price gains that they have experienced. And neither should you. This is a look at oil compared to the overall industrial production index cycle. And you can see our forecast for oil is to stay in the 80s, not exceed the 90s over the next 4 quarters. Normally, we would have this oil trend at, below 70. And it's scaled on the left, by the way, for oil, and not below 70, but below 80. But circumstances are what they are, and the trend is not weak enough up top in that green line to get us down into the 70s. But we're going to stay in the 80s. And here's my warning to you. If you see oil prices go above 90, the consumer is going to pull back even harder, and my forecast of better days in 2025 will be imperiled. And what could make those prices go above 90? The war, obviously, has that potential. I don't know that it's going to happen, but it has that potential. That's the big threat of the Israeli war on our economy, is exactly that. What's this mean for interest rates? Well, this is the 10-year government bond yield for the US and the 10-year government bond yield for Canada. First, notice that Canada is at 3.73%, lower than the US. What you are looking at is the world saying, the world bond market saying, Canada is a better risk portfolio, risk profile than the United States. There's more risk lending money to the US government than there is lending money to the Canadian government. It's an early sign of what I was talking about, how we continue to be very bullish on Canada during the 2030s. It's being recognized right now. The other thing I want you to see is that the rising trend is happening in both countries, and this big, huge sweep up beginning in 1950 and this big, huge sweep down through 2020 happened in both countries. Where are we going? Let me show you where we're going. We're going back to the future. Read this square from right to left. We're going to get some decline out of these 10-year government bond yields, a little bit like you see on the right-hand side of my square. But over the rest of the decade, we're looking at general rise in these 10-year government bond yields and therefore long-term interest rates in general. That's our future. We've got to figure out how to live with higher interest rates. But not even high interest rates, just higher interest rates. I want to remind you that life continued in the late 70s and the first half of the 1980s. Life did not stop. The world did not stop turning. Economics continued on. You just have to adapt to these higher interest rates. Figure out if you are interest rate sensitive and what that's going to mean and how you're going to counteract that interest rate sensitivity. And by the way, you find that interest rate sensitivity by looking at your business and how you have performed historically during periods of interest rate rise. And these are mortgage rates, 15 and 30-year mortgage rates, and that box is showing you the future. Again, start on the right and work your way left. We're not at stupid high interest rates on these mortgages. We're back to normalized interest rates. The pain was the shock of that, how fast that trend line went up. That's what froze everybody and has caught everybody, well, not everybody, but most people by surprise. Now we're going to get more gradual ascent. It's a lot easier to deal with that gradual ascent, but this is going to be pressure on the single-family housing market going forward. It means we're not going to get back into a normalized housing market anytime soon, in our view. Between the inventory and these higher rates, it's going to be tough sledding in that market, which makes multifamily housing look that much better by comparison. One of the markets that I'm looking at you, Paul, because I'd rather put my bet on multifamily housing, even though that's down today compared to single family. Over the course of the next 10 years, sir, or even the next 15 years, I'd be into multifamily more than single family housing. You asked for like an example of market differential. Both housing, but when you slice and dice it, it gets different dynamics. And here's the next wave of inflation. You're looking at US Treasury government issuance. Sometimes I get angry with you because you always make me do my mea culpas, right? So here's another mea culpa. See that peak in the COVID years in terms of issuances to cover all that fiscal policy and activity that was going on? I really did. I naively thought, we're not going to do that again. That was because there was a global pandemic. We were scared to death of what was going on, what it would mean for our economy. So they're not going to do that again. And indeed, following the Great Recession, that spike, which we thought was crazy at the time, they were behaving themselves until they get into this period, and all of a sudden there's a whole nother spike. And I said, oh, geez, I don't know how I could have seen that coming, folks. I really don't, as much as I do retrospective analysis. And then here we come with another huge spike. We're running at where we were on a 3-month moving total basis. We're running above where we were during COVID on a 12-month moving total basis, and there is no financial emergency. There is no financial crisis. There is no economic crisis. Yet we have engaged in this issuance of debt that is going to have ramifications for over a decade. And you and I can't do a darn thing about it except figure out what it's going to mean for our businesses and how we can make this work to our advantage. This is not the same playground that we're used to. This is a different set of rules that we are going to have to play by, and it's a different type of inflation coming away. There's about a 2-year lag between the low that you see in that dark blue line and when inflation rears its ugly head again. It's a 2-year lead time to inflation, which is what most people have a hard time grasping. We're used to living in a world where leading indicator movement is measured as 3 months, 6 months, maybe 9 months lead time. I'm telling you, there's a 24-month lead time involved here, and it is coming at you like a freight train. And you got to figure out how you're going to deal with a whole new round of sustained inflation, because that trend line isn't about to drop. They're hooked on this debt. It's gone. The horse is out of the barn, and they're chasing it. Wage pressures are going to keep the CPI from coming down in a normal manner. We also see it in terms of rents and rental equivalencies. All those factors are keeping the CPI on an elongated course downward. Bank credit conditions remain tight. They're likely going to remain tight until the end of 2024. It's also at the end of 2024 that we're going to get the lower, maybe even mid-2025, the low level of interest rates for this cycle. So while credit conditions are loosening up, interest rates will be coming down. That means if you are interested in buying a home or investment property or borrowing money for your business, that's going to be the time to do it. If it's for your business, try and make sure it's no more than a 7-year loan that you're getting on your for business purposes, because you want that sucker paid off before you hit 2031. Okay? You have a wry look on your face, sir. I am looking at you. He dragged you here, so it's not your fault that you have this wry look. Okay. You just reminded me of my first wife when I tried to talk to her about anything. That's all. Oh, yeah. Trust but verify. We're still doing the Friday afternoon Fed Watch. It's a YouTube put out by ITR Economics. So you go to ITR Economics YouTube, look for Fed Watch, and I take 3 to 7 minutes of your time to explain to you the data that's come out, what it means, what our view is for inflation and for interest rates. It's totally free, not up here selling anything to you. It's just pop it on your screen and take a view. We're gonna have some macroeconomic indicators. This is a good news slide. It is consistent with our economy doing reasonably well in 2024, all things considered. That bottom blue line, the darker one, that's real personal income. Real means adjusted for inflation. It excludes government. It's just earnings. And you see that growth trend is currently running a little hotter than the long-term growth trend. The takeaway there is, on average, or on median really, more Americans are making more money than they ever have before. They have more toys than they ever had before. They can buy whatever they darn well feel like buying, on median and on average. Notice that, and this is important because we're going into the silly season, notice that since 1990, except for when there are recessions, that trend line moves up. So when you hear some politician telling you, oh, this economic system of ours is grossly unfair, nobody's making as much money as they used to, and all that other mud they like to throw on the economy, understand that it isn't true. On median, on average, it is working great. Now, is there some bifurcation in through there? There absolutely is. And that's something that will likely get fixed during the 2030s. But all that means is you want to be targeting the higher end of the income strata rather than the lower end of the income strata. I'd rather be making frames for people who know art than making frames for Hobby Lobby, for instance. That's what that means in very real terms. You look at it in terms of with government expenditures, and you see the cockatoo head here, that's That was during COVID. Now it's right back on track with the long-term trend. This is incredibly important. Before it reversed direction, when it was still going down, we didn't know. We theorized, but we didn't know whether it was going to stop at that trend line and start rising again, or whether it was going to go down. Going down meant we were going to have a bad recession. Stabilizing and going back on trend means the economy was going to be okay, if not great. This is good news. We're looking at, is there anything that we see that could pull us off those trends? And given the tightness in labor, we don't think that is going to happen. Similar trends are occurring in Canada. You'll hear about credit card delinquencies and how that's on the rise and how people are so maxed out on their credit cards. Credit card delinquencies at 3.20%. That's barely within the realm of normal for credit card delinquencies. It is not problematic at that level. Automobile delinquency is in great shape at 4.17% delinquency rate. Residential, 1.78. That is absolutely zero issue involved there. In other words, the consumer's handling their debt. Headlines to the contrary. You will read that credit card balances are at a record high. They're always at a record high unless we're in a recession and people are defaulting on them, and they are not defaulting on them right now. Then that bottom one, domestic non-financial corporate profits at a record high, up 7.7% year over year. These are not signs of an economy that's about to flatline or even go down or even flatline is what I should say. We've got some modest growth ahead of us still in this economy. Just, it will be uneven. It depends on who you are selling to and what your markets are. I'm not afraid of any of these numbers. This is total retail sales, and it looks like that what I tried to show you with the material handling equipment. See that COVID surge in through there. It was hard to know whether we were going to see it normalize at that higher level or if it was going to have to go back down to that long-term growth trend. If it went back down to the long-term growth trend, it would have meant that we were in a depression. We didn't think that was going to happen, but we held our breath for many months. And the rate of change on the upper portion shows you that we think we're just back into some normalized growth. That's all it is, just normal growth rate for retail sales. Nothing perilous. It is going to be uneven. Why do I say that? And I was astounded by this statistic. Do you realize that the average credit card balance that is carried from one month to the next in the United States, you know what that number is? I'm going to round up because it's within $12. $7,000 a month is the average credit card balance Americans are carrying from one month to the next. That just blew my little mind. I felt like the first George Bush, who didn't know about how you could scan barcodes in a supermarket. I mean, I was that out of touch with reality, I suppose. That $7,000 was a lot more manageable at 12% interest on that credit card. It's a lot more difficult to manage at 21, 22% rate of interest on that credit card. That takes them out of going out to eat as often. It takes them out of buying stuff just to buy stuff market. Again, it's the upper income levels aren't going to know anything about a slowdown. The lower income levels are going to bear a disproportionate share of this pain. And you know what your businesses are all about more than I could ever. Mexico, you see the same surge post-COVID, the same slowdown based on the rates of change, except it's more pronounced in Mexico, which is why I know Mexico production isn't based on what's going on domestically. It's based on foreign activity coming in. And then taking a look at, there we go, Canada. See how Canada never had that COVID surge? They were just normal because they never really overstimulated their economy with fiscal policy and free money. Canadians didn't believe in doing that. And therefore, they don't have quite as much of a concern about all that inventory issues that we have here in the United States. This is a map about housing. What we're doing here is we're looking at U.S. household income by state average, and then we're comparing it to what it takes to buy a house, the average house price in each state. In California, the average household comes up $138,000 shy of being able to afford the average house, which is why there's an exodus part of the reason why there's an exodus from California. Here in Texas, we're at $27,000 shy of being able to afford the average house. Part of that is you have so many people moving in here, the demand is just outstripping supply. But you know, at $26,000, $27,000, that's not that hard to overcome because real incomes are going up. because mortgage rates will come down maybe another 100 bips. And what it means is instead of getting a 2,800 square foot home as a first home, some people are going to have to realize that their first home is going to be 2,200 square feet, 1,800 square feet. Maybe instead of 3 bathrooms, you're going to get 2 bathrooms. Now, all of a sudden, you can easily afford that home, even though you have a gap like that. But it changes the expectations have to change, and that's a cultural mind shift. And I think it's particularly difficult here in Texas, with all due respect, because you all are used to thinking big. I mean, big. You don't think small or anything. It's always bigger and bigger here in Texas. You all have the biggest everything here in Texas. So how are you going to get the next generation to think smaller? I'm imploring you to try to do that, because Al and I have run the numbers. They need to get in that house in 24, 25. Help them do it. Help them see that they can do it. But they need to get in 24, 25. And even with the deflation that we see in the 2030s, they're going to come out on top. But if they wait until 28, 29 to buy that house, thinking that there's going to be a dip in interest rates and that it'll be better somehow if they delay, then they will not come out on top. They will be underwater on their housing at the bottom of that 2030s period. So they have to move relatively soon. And you get the benefit of kicking them out of your house at the same time. There are 2 green states here. West Virginia, you have $10,000 extra if you live in West Virginia to buy that average house. Why? Because no one wants to live in West Virginia, folks. That's why. And same thing with Louisiana. They're in the plus because people are moving out of West Virginia. West Virginia is our China, and Louisiana is like Thailand, losing people on a fairly rapid clip. Do not buy where you see significant amounts of red. Colorado is still way overpriced, as is Utah, as is California, as is Hawaii. Now you're looking at building permits. And I tell you what, 2 months ago, this map was essentially all green, like you see in the Northeast. Green is in Phase B. It's where permits are running above year-ago levels, and most of it was at double-digit levels. Now you see mostly orange, and orange means it's still positive on a year-over-year basis. But the rate of rise has slowed down. I've run the analysis, folks, and I don't have anything to show you in this presentation, but for our take, we expect that this is going to go blinking between orange and red throughout the rest of this year, is what it looks like to us. It's not going to go into negative territory. The only negative territory is out there on the East Coast. What is that, New Jersey, down year over year. And any of you from New Jersey? And who really cares about New Jersey, right? Montana is way up, got the strongest number because 3 people moved in last quarter. So I mean, you got to understand the numbers before you do anything with them. Take another look at oil, and I know, Chris, you talked some about oil. I just wanted to show that the oil rate of change is beginning to turn around. It's at minus 13.5 and rising. Well, there's generally a coincident relationship overall between the rig count and oil. You can see it frequently will lag behind the oil. I think the rig activity, in other words, is on the cusp of getting better in the second half of this year and stronger still in 2025, based on where we see oil prices going. In Texas rotary rig count, I want to show you that we have some reversal in the rate of change built in. We had the trend flattening out. It's going to go negative, lower than our forecasted, but it's not going to turn into anything steep. And we think we are going to get that modicum of rise in 2025 in the Texas rig count as well. Material handling equipment inventories. This could be you. I'm just stressing the point. They didn't expect to find themselves with too much in the way of inventory in their supply chain. A lot of you could be feeling that same situation. The best thing you can do is just work down that inventory as fast as you possibly can, get it flushed out of the system, and let demand in 2025 take you back up on that next rising trend with low inventories instead of excess inventories. I'm tired of that one. Non-residential construction, blue line up there, 20.3% is the year-over-year percent change on an annual basis, but it's rounded the bend. It's rounded the bend on time with what we thought it was going to be. Housing leads by 24 months. So this green line is already telling us what to expect for non-residential construction. It would be worse if it wasn't for the CHIPS Act and the infrastructure activity. That trend line would be steeper and be going lower, but we have moderated it for those two reasons. But private non-residential construction is going to be a lot different than government-fed non-residential construction. Understand that, please. There are going to be two different worlds in that scenario. All right. We think housing affordability is going to be an issue through 2024 and beyond, really. Kids are going to have a hard time getting into those. What keeps me up at night, in other words, is commercial real estate and the flood of refinancing that has to take place there. If anything makes me toss and turn at night, it is that. And the Republic First failure that we just went through is part and parcel with that. Any interest rate decline is not likely going to help those people that are carrying more than $7,000 month-to-month balances. They're going to remain in a very tight situation. When I look at interest rates, when I look at inflation, when I look at the rest of the world's interest rates and inflation, and I told you I would come to this, we see the US dollar remaining relatively strong for the next 3 years anyways. I wouldn't expect any big change in the dollar's valuation. We're going to be carrying more of an inflation load than some other countries. Of course, there's Argentina running at 261%. We're not Argentina. But we're going to be running higher rate of inflation than will Europe, than will others. Mainly because we're in a better position than they are, and they're not stimulating their economy like we are stimulating ours. Just what I was talking about before, the green shoots in housing we think are real, even though you saw a lot of orange there, and this is the time, in our view, where we are in this longer-term cycle to be getting into the housing market. People. Unemployment is low all over the place. It's different in each country, obviously, as you can see by the numbers on the right, but 5.9% for Canada is exceedingly low, even though we would consider that high. It's a relative term. But labor is tight all over North America, folks. And we're not exactly going to see a flood of more people coming at us to make the situation go away. It's politically never going to happen, at least not in the near term, never. These are labor participation rates. And except for 65 plus, we are above where we were pre-COVID. In other words, the great resignation has come back to being the great they're back. We have benefited from them coming back to work. Given our slow demographic rate of growth, this is going to be about as lubricated as the labor market is going to be. So you got to work with that dynamic. Right now, it's not uncommon to hear people say, well, it's been easier to hire people. There's more stickiness involved with my labor, et cetera. Enjoy it while it lasts, because come 2025, when we're accelerating in the next business cycle, they're likely to start job hopping all over again. So figure out how you're going to keep them with you. But it's going to make your culture so much better than anybody else's culture, why they're going to love you. People have a tendency to look at the 16 to 24-year-old line and say, I knew it. I knew that they were lazy. That proves they are lazy. They just don't want to work. And I say, you're wrong. What that proves is that they're smart. They know they don't have to work because you're giving them the money. Stop it. And they'll go to work. And if you don't give it to them, they know the government will. They got it both ways. Why should they work? They're not going to work until they get out of college. At least not like at the same rates that they used to work. And I mentioned 65 and older haven't come back to pre-COVID levels. We don't know if they're going to. What I do know is that they could be on their way to your door. And it's going to take a while to get there before you know if they're applying for a job or not. Come on, guys. That was a good Walker impression, wasn't it? I live on Marco Island. I know of what I speak, okay? Southwest Florida, man, we don't do anything down there. We're finally getting some rate of change reversal in weekly earnings for production and non-supervisory transportation and warehousing workers. But look how high those rates went. So we've slowed down to a 4.4% rate of growth. That's still going to make inflation very, very sticky on the way down. And because labor remains tight, we're not likely going to get a big benefit from that. Higher income levels aren't going to know anything about weakness in our economy, tightness in the labor market. These are all things that I've said before. Take into consideration the demographics and economic diversity of where you are thinking about expanding. What I mean by that is, I love Texas. I think anybody would be crazy not to be here, be in the Carolinas, be in northern Florida, be in Kentucky, be in Utah. But I'll be darned if I know why anybody would want to invest in Illinois or West Virginia or Louisiana or any place else that has a negative demographic. It'd be suicide. I'm running out of time, so I'm going to go right over to this. Demographics. The demographic reality is this. We're still growing demographically in the United States, but at a very slow pace. But at least we are growing. I've shown you before where China's demographic, their population is actively shrinking. And it is shrinking at a quicker and quicker pace. Did you also know that besides, you probably already did, Japan is in decline population-wise. Thailand, I just told you, is in decline population-wise, and so is China. Korea is still growing. Did you know that all of Western Europe is in demographic decline except for the Brits? Only the Brits are still procreating enough to make their world better. Could be why they wanted to go into Brexit, so they didn't get dragged down with the rest of Europe. Imagine, you're not grasping what I'm talking about based on the faces I'm looking at. Think of your business. I don't care what it is. Ultimately, there's a consumer who is the final demand for whatever it is that you do, that makes whatever it is you do possible. Now imagine in your world where you know there's going to be fewer consumers next year, and fewer the year after that, and fewer the year after that. We have all built up our businesses to handle X level of demand. But with your demographic going down, what you need is X minus Y capacity. What are you going to do with that excess capacity? You're just going to shut it down? Or if you're China, are you going to say, I'm going to export so I can cover that Y capacity? And who's the number one market they're going to try and export to? It's the United States of America. Which is why you're going to see even more trade barriers going up. You're going to see more economic friction between the United States and China. You're also going to start to see more and more of it vis-a-vis Europe, because their demographic trend is negative also. And they're going to want to tap into the US market, your market, even more. We have just begun this nationalization phenomenon, US first phenomenon. You think it's pronounced now, we're not even close to where it's going to be going. Made in the USA is going to be paramount to a lot of businesses because of the political and global environment, and because we can't take the threat of declining prices, or we're going to try and delay the threat of declining prices spawning from all this negative demographic activity. Healthcare costs are going to continue to rise in the United States because we're aging out. 80% of our healthcare dollars are consumed in the last 2 years of our lives. The good news there is that by 2036, the majority of us baby boomers are dead. So that's going to help curtail that escalation of healthcare costs, because, you know, once you bury us, we don't take a whole lot of time up out of doctors and all those other folks. They don't really care anymore. Neither do we. Entitlements is continuing to grow. Oh my gosh, I didn't bring along the trend because I didn't have the time, but it is blistering. We're expecting more and more out of our government, and our government is having less and less ability to fund discretionary things. Here's a little fun fact. Next time you're talking to somebody at a cocktail party and they bring up how much the government spends on defense spending, take this home, please. Defense spending accounts for 3.6% of our GDP. It isn't even half of what the government spends, because it's on that line that it's about half of 35% in terms of government expenditures. We are spending far more money on entitlement programs than we are on defense spending. So just keep the numbers in mind. The numbers have to do the talking. Inflation, I've already talked about. U.S. national debt is continuing to climb, as we have talked about before. We're way over that 80% threshold. That is that tipping point. We're continuing to push upward on that percentage. We're continuing to push upward on the dollars, and it's going to be accelerating thanks to all the deficit spending that we are engaging in. Ask yourself these questions, if you would please, regarding the 2030s. Is your business interest rate sensitive? Do you respond well, or do you respond badly, or do you not respond at all to when interest rates are going up? I've seen all three types of businesses in my career. Which one are you? Because as interest rates rise between now and 2031, how is that going to impact you? And how are you going to come up with a strategy to mitigate that influence? Are you price sensitive? Do you benefit from inflation, or are you commoditized business that you don't benefit that much from price inflation? What about deflation on the other side of it? If you're a home builder, you realize you're going to get crushed if home prices are going down beginning in 2034 and down again in 2035 and 36. You will be absolutely crushed. What are you going to do about that? It's not to accept your fate, it's what are you going to do about that? It's very much the same advice you would give your kids. Look, they want to be involved. Your kids need to be involved in the STEM disciplines. You need to be involved in the STEM disciplines. We're going to spend money on hospitals and nursing and medicine still, and long after we're buying frames for our art. Because that, you got to think, am I involved in an industry that is deemed to be essential for whatever reason, or am I involved in an industry that is largely discretionary? If you're involved in an industry that is largely discretionary, you're not going to like the 2030s. You need to find those industries where you can be a valuable player, where it's not so discretionary in terms of consumer demand pull. And that ranges from nursing, physician's assistants, to dog food, dog toys. All those things do well, even though there's a depression. Pharmaceuticals do well, but so does hairspray, makeup, shaving. All that stuff continues on. No matter how bad things get, unless you're in the grunge movement, we try and look good. So even if you're in the packaging business, can you become a packager in healthcare or Vanity Fair, whatever you want to call it? Can you make inroads into that market, even though you're not there today? You have time enough to think about these things today. Is your business positively or negatively correlated to the financial markets? And I always go back to our white paper, Chris. So many business owners are positively correlated to the financial markets, and you're going to make sure that isn't you. Do not be positively correlated to the financial markets in terms of your business, because the stock market, for demographic reasons, is coming under a lot of downside pressure in the 2030s. And if your business is going down in value, along with the stock market going down in value, then you're going to get hurt twice. So you got to start fixing that problem today. You don't have the option of waiting 3 years before you figure that out. It's a long course of action. Okay. Market activity that is largely non-discretionary again. Can I give you another piece of advice, if I may? Your best friend is going to be a tax advisor, because the government's coming after your money. You're in this room not because you don't need a tax advisor, and you're going to need one on steroids going through this period. They're coming after you. So let's combine a couple of things. You have kids going through school. Tell them you'll pay for it if they can become your tax advisor. Tell them they're on their own if they don't want to be a tax advisor in the family. I mean, let's steer this ship the way it's supposed to be. I have to relinquish this to Chris right now, so I'm going to skip that other slide. I'm right on time for you, Chris. One last thought for you is, though, based on the demographics that I've tried to describe to you, if you truly, truly want to make America great, go home and procreate. We need more people. Make America great. Procreate. Right? What'd you learn at the Baird conference? Honey, this is for America. That's what you learned today. Thank you very much. It's on the deck.
So I believe Brian will be selling T-shirts with that slogan out front. So pick those up on your way out. So I'm going to talk, we do in the Bear Generational Wealth Group a lot of different things. And from data aggregation to sounding board, I'm going to talk today about financial strategies for the next 10 minutes, and we'll have time to answer questions. Brian will have time to answer some questions. I'd talk about data aggregation, but And nobody's going to listen to that for 10 minutes. So I'll talk, where's the clipper right here? So financial strategy. All right, so we always start, and the reason that I talked earlier about knowing where you are within the cycle, because it's really important, and that's the first thing that we talk about when we're sitting there going, every quarter, where are we in the cycle? We use input from people like Brian, we use other resources that we have available to us to kind of figure that out. And so what I'm showing you is a cycle that runs a baseline of optimism up to euphoria, down to capitulation. It's interesting because capitulation is something people say, well, what's that? That's when you got to get out of the burning house. We've not had capitulation in our financial markets for 15 years. So the last time was in the 08-09 financial crisis. 2020, during the pandemic, we got close. We got down to sort of panic, but we never got quite to capitulation because of all the stimulus that rolled in, and we bounced right up. So we've kind of been glossing over that capitulation. So where were we a year ago? A year ago on May 10th, and I should tell you that is a typo up there. That shouldn't say 5/10/23, should say 3/31, because that's the most recent conclusion we have. But a year ago, we were right at the level of fear, and we moved across that straight to optimism, and now we're moving up the other side of the curve. So we're right at that area of thrill as of March 31st. And given that, when we talk in terms of how to position clients, we're talking now, again, not overreacting to that, but not underacting either. So we're looking for opportunities to opportunistically move out of some of the more risky asset classes and bring down on a very tax efficient way some of the exposures, because we're moving up towards that euphoria. So how do we know that? Well, we know that because individual investor optimism is like at the levels. So basically the line that's moving through there is sort of the average allocation, moves up and down one standard deviation around that. When it gets to above 70%, or close to 70%, that's usually associated with some sort of corrective activity in the market. Okay, when we get down to that 45% area, that's like the best buying opportunities you can have, because that's when that's capitulation. That's when people are throwing out their investments and just trying to get out. So in May of last year, we were right in the middle of that. So we weren't near, an area where it was like that scary. But now we're moving up towards that level. We're moving towards a more euphoric level in the financial markets. Valuations will tell us that as well. So what you're looking at here is the cyclically adjusted price earnings ratio. That's Robert Shiller's metric. There's a lot of metrics for value. This is one that we use. The blue line is the CAPE ratio. We use this because the data goes back a long time. I mean, he's got data that goes back to 1900. We're showing you data from 1990 on here. We sliced and diced it, so we're looking at percentile rankings, and we wanted to know what was the forward return in each of those different levels. So the red line and the gray line are what turns out to be important there. When you're above the red line, a new dollar of investment has about a 3.9% return on average. It doesn't tell you what's going to happen in the next year. All that means is that you put a new dollar in, go out 5 years, look back, and that new dollar should have returned expected about 3.9%, okay, on average. Below the gray line, that's where things get exciting. You get to 11.5%. And so last year when we were here, where were we? We were right at about that gray line. Where are we today? We're above the red line. So that's why we're saying now's the time to start opportunistically looking for places to reduce risk exposure. Okay, so what did we talk about? So last year, Brian said, hey, I want you to talk about these three things. He said impact of, you talk about the weakened U.S. dollar, what that's going to do, shortfall on rig count, is that investable somehow? And he said, your thoughts on a good time to invest in AI, and what would that be? So we talked a little bit about dollar cycles. So we're still expecting the dollar's held up remarkably well. That's because the economy has been so resilient, as Brian's talked about. It's also because interest rates have moved up. So interest rates have gone from 3.6% a year ago to about 4.6% today, the 10-year. Okay, so that's kept the dollar high. We still expect some cyclical decline in the dollar. That's usually an environment where gold does well. But look at that, gold did well in spite of the fact that the dollar held up. So gold had a pretty decent return over the last year, so it was up about 13%. Up one of the best performing asset classes actually in the first quarter. But that's not because people are investing in gold. So institutions, individuals, actually there's net outflows from gold ETFs. It's really been from buying of central banks around the world, particularly China. Okay, so China, for the central banks around the world, for example, have bought twice as much gold, so over 1,000 tons of gold last year and the year before, than they bought on average in all of the 10 years prior to that. So why are they buying gold? They're trying to diversify away from the dollar and not buying U.S. Treasuries. There's some people that would say the whole reason Janet Yellen has been going back and forth from China, over the last year is to try to convince the Chinese to buy more bonds because they see them buying gold. So why not buy U.S. bonds, and maybe if you do that, so some negotiation. There's people that actually theorize that. So the dollar actually went up during that period of time, up 4.7%. And again, for those reasons. So is the low rig count last year that we're looking at, is that investable? Well, oil moved up $72 a barrel a year ago, got as high as $95 in September. It's back down today to around 78. But the overall return for the energy select index in that period of time was pretty decent. In fact, in the first quarter of this year, energy was also one of the best performing asset classes, better than the S&P for both gold and energy. But what does that mean today? So how does that transfer into what's going on today? So Brian talked about oil, so I'm not going to spend a lot of time talking about that. We think it's sideways, but we do think in additional labor, which he mentioned, energy is going to be what keeps inflation sticky. And energy, think about in terms of, we always think about oil, but really we should start thinking about electricity. Because electricity, we've always thought about electricity as water, you plug in, it's free everywhere, not something. But if anybody remembers what happened to water over the last 10 years, where now suddenly you go to a basketball game and you pay $9 for a bottle of water, electricity, same thing's happening. So in the last 2.5 years, electricity on average in the United States up 23%. So what's driving that? Well, it could be EVs. So EVs are 7% now of new car sales, but only 1% of all cars on the road are EVs. Okay? What's driving this big boom is AI. So the increase in demand from data centers around the country is driving, here in Texas, it's been the crypto miners, but just AI data centers in general are driving electricity demand up. So McKinsey expects over the next 5 years, the demand from AI data centers for electricity to double. So what does that mean, double? That sounds kind of but let me put it into context for you. To meet a doubling of demand in AI in the next 5 years will require getting through the process and building 15 to 18 new nuclear reactor power plants. Okay, we only have roughly 90 in the country. Okay, so how would that happen? So there's places going back there trying to keep from decommissioning coal. In the state of Georgia, where they were actually trying to incentivize the building of AI data centers, they had to roll that back because Georgia Power came out in December and said, this is off the charts, we can't do this. They actually put through their process to get 3 new coal-powered generators back online. Okay, so this is a phenomenon that's taking place and happening very, very quickly. So that happened in the last 2.5 years. It's happening faster than we can actually grasp what's happening with it. Because there's been so much, so the spend for construction building, for like building data warehouses, data centers, the manufacturing here in the United States that they're trying to bring back to the onshoring, we're at 30 to 50-year highs in terms of what's been spent on that in the last year. It's pretty shocking and happening very, very quickly. So if you have a new factory that opens up and you want to get online to your power grid, it may be a 2-year wait just for you to get the transformers that you need right now to do that. Okay, so they're running into problems. As I mentioned, the state of Georgia, they're rolling that back. They're saying, okay, we no longer want more data centers. So data centers are trying to figure out. They're not locating in the state of California because while the average is up 23, so Texas is about in line. California, over that 2.5 year period of time, electricity costs went up anywhere from 40 to 60%. And they're still rising. So if you look around the country. So they asked Sam Altman from OpenAI this question a month ago. He's at a conference. He's the guy that ChatGPT was made by them. How will this problem get solved? And Sam Altman looked at him and said, well, I think that we'll have fusion will solve that. And somebody looked at him and said, well, isn't fusion like 15 years away? And Sam Altman said, well, maybe AI will help us get there faster. So very circular in terms of the question. Elon Musk shocked the crowd, and Elon Musk says a lot of crazy stuff, but he shocked the group by saying next year he thinks we'll have blackouts. So this is going to be a very interesting area to watch. Electricity normally boring like water, but this is something that everybody should be paying attention to. And again, to reiterate what Brian said, I mean, you get gas prices. The administration is doing everything they can to keep oil down. They're not enforcing the Iran sanctions. They're not enforcing this, and they will tap the SPR if they need to. It's the power of an incumbent administration. They need to keep gas prices from going above $4. Since this was first done, we're saying gas was at 352. It's up a dime from there on average. So gas is up about 15% year to date. It goes higher through the summer. That's problematic for the current administration. Inflation, why are we paying attention to this? And everything that we look at says when you have a first wave of inflation, it's followed by a second wave of inflation 87% of the time. So when Brian says that, I can go, oh, I put a lot of confidence in what he's saying because that's what the data historically shows. Some of the other things that data shows is valuations don't do well when you get to higher inflation environments, and that's what he's talking here. So when you get from an S&P standpoint, we're right between 2 to 4% right now. We're a little bit above that from a multiple standpoint. If we get back out to 4 to 6% or 6 to 8, in that kind of inflation, you should expect a somewhere 30 to 50% decline on the S&P 500 should that come to pass. That's a sobering thought, and for a lot of people that we work with, or they hear Brian speak, they come to us and say, well, I got a business. I'm not going to run my business through that. I'm going to try to sell my business in the next 5 years. They come to us. So the first thing we want to tell them is, okay, first you need to figure out, well, how much do you need to be able to sell your business successfully, live your life? And this was somebody that came to us. They had a fairly high spend. They were going to get about $25 million after tax for their business. And we looked at that over a 30-year period of time, which is what their horizon would be. That red line in there is a bust. Okay, so that's not a good outcome. That's not a good place to be because that means they're going to run out of money. And so we said to them, well, either you need to get more for your business, so you need to undertake certain activities to be able to sell your business for more than what you plan to, or you need to plan to spend less when you go forward. So it's always important to know where you're starting from and how much you need. Once you know you're going to have money that is going to outlive you, there's only 4 places it can go. It can go to the government. We talked about that earlier. The government's coming, right? You can certainly give it to them. I've had clients actually say to me, I don't mind giving some money to the government because, the whole reason that I have the success I do is because I was able to do it here, so I'm willing to give some away. But most want to give to heirs, charity. We're told that we're the only advisor that actually tells people they should spend more during their lifetime. I am a big believer, you worked hard during your life, you should spend more. I mean, I tell the story all the time about a client out in Washington, D.C. who heard me say that he's worked hard his whole life. And now he flies private everywhere he goes because it's like, I only have so much time left. So I'm going to spend that money flying private because, I want to enjoy the time I have here. And if I leave it to my kids, they're just going to spend it. They'll fly private and I won't get you. So, but they're coming. And so I would be remiss if I didn't talk about what's coming up in the next year. Okay, because this is coming at us very fast. This is the Tax Cut and Jobs Act expiring in 25, and most people think in terms of a state plan. So if Congress does nothing, okay, this is what will happen. They have to actually do something. They have to legislate in some way. They have to come together with some sort of agreement for what's up here to not have happen. And most of the things are not all that good because you see the top tax bracket's going to go up almost 3%. 37 to 39.6. You're going to see the standard deduction is going to go away, so there's going to be a lot more people having to deduct. AMT comes back, so a lot more people will be caught by AMT. SALT comes back, so if you got a big deduction here in Texas, that doesn't really help you a lot, but it helps people out in New York and some of the East Coast states where they get the big deduction for state income taxes. Mortgage deduction comes back, so a lot of deductions come back in. The only thing that really doesn't change, they made permanent the tax cut for corporations. So if you're a publicly held corporation, that's a good thing. So that it's not expected that this would affect the stock market in a big way because tax cut's not going to go up on that. But for small business with the qualified business income deduction, that's going to affect them dramatically. So that's probably an area where something may get done. And then the estate exclusion goes up. It's actually about $13.6 million in 24, and that's going to get cut in half. So the message here is like, you do planning, because they're coming, he said tax advisor, but you got to start with the planning early. You can't wait. Brian and I were talking about this earlier because we got a lot of people coming up, hey, I want to do something before the 2030s. And if that's the goal, okay, there's a lot that has to happen now. Because so when you worked on your own transaction that you had, I mean, Brian didn't start that yesterday or last year. I mean, it was started 6 or 7 years ago. Okay, and that's what needs to happen because that sort of planning, it takes a while to go. So with that, I want to thank you all for being here. And again, Brian, thank you. Very nice job.
Thank you, Chris.
Yeah.